I often get asked why gas station business is a good investment when there are so many other great franchise opportunities out there. My reply is there are 7 great reasons why it is a great and solid long-term investment compared to many other businesses and ideas and opportunities that are out there. Let's discuss these 7 undeniable reasons why gas station business is one of the best long-term investments out. And at the end, I hope you will agree with me. So let's discuss this.
Welcome to the one and only Gas Station Business 101 podcast, where you can learn all the secrets about how to start and operate a gas station business successfully and make money. This podcast is brought to you by the good folks at GSB Academy Publishing Company. And now, here is your host, Shabbir Hossain.
Welcome to Gas Station Business 101 podcast. I'm your host, Shabbir Hossain, and this is episode number 39. This is the only show of its kind where we discuss how to start, run, and grow a gas station business successfully. And I give you the inside look at many real-life case studies so you can follow and become successful in this business. As for today's topic, why is gas station business a good and solid long-term investment? That is the question I get asked often, and I have debated on this topic many times before. And I want to present my case to you so you can decide and see if you agree with me. There are many great businesses and investment opportunities out there. I have no doubts about that. But is every one of them is a proven one? I don't know. I have tried a few. If you listen to my previous episodes, even my very first episode and the episode that I've done about all the failure that I have had in my business life, you will know that I've tried many different types of businesses. From selling computers to wholesaling to fast food, I have tried a few. But at the end, I still am staying with gas station business. Why? Well, that's the reason. We will discuss all those 7 points so you can see why I have stayed in this line of business. But before we get into that, for argument's sake, let's talk about some of the other ideas that are out there. If you ever read the Entrepreneur magazine or any franchise type business magazines, then I'm sure you have seen a list of names of different franchises that they list every year as the top 10 businesses to get into. I'm sure you have seen billboards or ads where a franchise claims that they're the number one franchise for 2015 or 2016 by, they name a magazine, say Entrepreneur magazine or Franchise magazine or QSR magazine. And I have seen many of those over the years. And that's how I got into Quiznos, as a matter of fact. I'm not sure exactly which magazine that was. I believe it was back in 2004, 5, or 6. Around that time, one of those magazines put Quiznos as the number one franchise to get into. They said this is the best business opportunity to be had in this country. And well, when I made my decision to get into Quiznos, part of that reason was that magazine's list, because I believed it. And again, I don't think they misled the readers about Quiznos being number one, because back then the growth rate, the income potential, and everything else they researched. That magazine, the writers, they're smart people. They researched and everything showed that this was one of the fastest growing franchise. But one thing they did not get to see is the rise and fall of Quiznos. Well, they were taking data at the time, whatever was available to them. And nobody can see future, so I'm sure they didn't get to see future. I did get to see that future, and many other franchise owners like myself, have seen that rise and fall of that franchise. There are many other businesses that do have this life cycle that are very short-lived. And if you get into one of these type of short-lived franchises, what happens then? What happens to your investment? Let's say you invest $200,000, $300,000 to get into one of these franchise businesses. 3 years down the road, this business doesn't make any more money. Even it loses money. You didn't get your $300,000 back in 3 years because I'm sure you weren't making over $100,000 net profit in every year. If you did, good for you. That means you got your investment back. Then in 3 years, after you closed the business, you didn't gain anything. You didn't lose anything. You wasted 3 years of your life. So I'm not sure which one is good, which one is bad. But I am not suggesting that every time somebody opens a franchise business, though it could be a restaurant, it could be a janitorial service, it could be a office product supply service, or anything else for that matter. In those list of 20 businesses, not all are food, all are packaging and shipping business. There are varieties of business. And not all of them will close in 3 to 5 years. But if you also remember a general rule of thumb, if you open a new business, a majority of it, I'm not sure exactly what percentage, I believe it's 30 to 40% of new businesses do not survive more than 5 years. But franchise businesses tend to survive longer because they have a proven system that they implement. The quality of the product is implemented forcefully in a way where they keep an eye on those franchisees to make sure that the quality is maintained all over the chain. That's why a McDonald's hamburger tastes same in Alabama versus in New York City. And that's the reason some of the franchise survives longer. Some of them survive for years and decades. And there are McDonald's in our city. There are other businesses in our city, Burger King, Wendy's, that I have seen for the last 30 years. So there are not all bread franchises. And there are not just fast food that survive longer than anybody else. But there are other businesses that you have seen that come and go in just 3 to 5 years. But what happens to the investment of those owners? And when you buy a franchise, how do you know this is the one that will survive next 30 years and not die in next 5 years? But as for food franchises, since I have done one and I've lost a lot of money, and if any of you have listened to my previous podcast, you know I had not one, I had many Quiznos restaurants and I closed them all down. As for food franchise, my only fear is if you're going with something new and shiny, what if they don't survive more than 5 years? Because the barrier to entry in food business is limited, relatively lower compared to some other businesses. So I believe anywhere you live in this world, doesn't have to be the United States, I am positive you can look around you and see new food businesses that are coming up everywhere. There might be a fast food burger joint that's opening up. There might be a seafood place that's opening up. There might be a Greek place that's opening up. It could be a franchise. It may not be a franchise. It may be a personal owned. But when you open a franchise restaurant, you're still competing with that mom and pop Greek shop that they opened up selling Greek sandwiches, or the person that's selling homemade burgers without a franchise, or with the new Subway they opened up next door. So food is a tough market to be in. But there are other businesses, I'm sure, not food related. And yes, there are other good business opportunities. The reason I'm mentioning all this because I have had some discussions lately, even about strip malls. Some of you may notice that there are many strip malls coming up all over the town in every city. These strip malls typically have anywhere from 3 to 7, 8 retail spaces that they lease out or they try to lease out. And I'm sure you have seen where it's a nail salon or hair salon, a fast food, and typically maybe a insurance office, things of that nature. And they're a very good idea because it is a fantastic opportunity if you can do it right and make sure it's all leased out. Because once you build it, if all of the spaces are rented out, then it is a very good long-term investment for you because those businesses will be there. And let's say one of those businesses didn't survive, they leave, somebody else leases that space, you still get your rent. And after your loan is paid off, that property is generating quite a bit of income for you. And any commercial property you charge by the square foot. It's not by a flat rent. Let's say, here is a store, pay me $1,000 a month. No. If the store is 1,200 square footage or 1,000 square foot, whatever it is, you charge by the square feet. And it is a established rate pretty much. So in your area, let's say the other retail spaces, based on location, if they're charging $20 or $22, you can stay in the middle and say, mine, I will charge $20, and you attract some good solid tenants and do it that way. 7 to 10 years ago, this was a very good idea. And whoever got into it at the beginning stage of this idea of investment, they're still doing well because they leased out these spaces with a long-term lease. Your goal would be to get a tenant that will stay for many years to come. You do not want a tenant that wants to lease it for a year or two. And if you, as I said, get a good tenant that signed a 15-year lease, then you're set because your bank loan most likely is for 7 to 10 years. So once that loan is paid off, you're generating quite a bit of income without much of an expense. But now that there are many strip malls everywhere, you may see few of them with only 1 or 2 space rented out and rest of them are empty. What happens in that case? Your bank gave you a loan to buy that land and to build the stores. It's a construction, it's a cost, it's quite a bit of expense. If you can only lease out 1 or 2 out of your 7 spaces, who's taking the loss every month? Bank will not give you a time to say, okay, until you lease out all the spaces, you do not have to pay me back. That's not going to happen. Bank wants their money. So you will find yourself in trouble and paying out of your own pocket to make that banknote. If not, you have to file bankruptcy and hand that strip mall back to the bank. So that is the risk you take. And well, there are ways to minimize that risk. Once you get an idea, this is what I will do, you can put up a sign on a vacant land that says, now leasing. And once you get enough people to inquire about it, you pick out some good ones and you ask them if they're serious about it, they can sign a long-term lease with you. And you can build it to their specification, provided that they're good and solid companies with good financial background. But again, as I said, it's not that easy to find those because you have to find all 7 good solid tenant. Well, as long as you find maybe 6, you're doing good. If you find all 7, you're doing great. But what if you only find 2 and the rest of the 5 are staying empty? Then the 2 tenants that you have that are good may say, hey, you need to fill up the other spaces because I don't want to be in an empty, vacant spot where I'm not generating enough business, because most businesses want to have customers from other businesses. That's why a lot of times you want to open a store next to a busy grocery store or something like that where you feed off of each other. So if you do not fill out the other ones, the other 2 tenants may find a way to get out of that lease because they're saying they're not generating enough business because they're in a spot where not very many traffic are flowing through. And these are the reasons, if you see any vacant or halfway vacant strip mall, you know why. On the other hand, how many gas stations do you see that are being built every day? Not very many, I suppose. And how many gas stations do you see that are vacant and closed? Again, not many, I suppose. Why is that? Well, the reason for it is it's not easy to build a gas station. It's quite a bit of investment. Plus, you need to have a unique piece of property to open it. Not like strip mall, any vacant land, you cannot open a gas station. Because remember this, when you're building a gas station, I'm sure you will want to brand it with somebody. So let's say you got a great idea and you have the money for it. You want to open a gas station and you approach Exxon, Shell, Mobil, whoever it is. They have their own research team. Once you approach them, since you want to carry their brand, it's not that they're paying you money to open that gas station. You're spending your own money, but you want to carry their brand. What they will do is they will do their own research and come to you and say, either they will say, it's a great idea and we will let you brand and this is how we'll help you brand it. Or they will say, we do not think it's a good idea. We did not see in our research that it would generate enough gallon sales for us to brand it. So we are sorry, find somebody else. You see, so there is a backup safety net, meaning just because you thought it's a great idea to open a location or build a station doesn't mean it's a great idea. But these are people that are very professional and that is what they do all their life. They do research on locations and tell you if you build a station in this location, if that station would generate enough business or not. So there is a safety net. And that is one of the reasons you do not see too many of these gas stations going out of business, going belly up, shutting down. Yes, there are some. In some states, you will see a great corner that has a gas station that's halfway broken or vacant. There are other reasons for it. It's not because of the location. It very well could be a regulation change and that the underground storage tank had some type of problem or contamination or a leak where they contaminated the land underneath and the environmental department had to come shut it down and started cleaning up the property. Yes, it has happened and it can happen to some of the older facilities. It doesn't happen anymore to the newer ones because nowadays we use different technology for underground storage tank. But if the station was built back in 50s or 60s, those were metal tanks and yes, they have leaked before. So in extreme events, yes, that has happened. And if somebody wants to buy those, usually those properties come with a restriction in the deed that says you can open any other business other than gas stations. So a corner property becomes very valuable. Usually a corner property is more valuable than any other property. But if it comes with a deed restriction, then people don't want to pay the high price buying that corner knowing they cannot open a gas station. So again, could be other reasons, but you do not see too many fairly new gas stations being shut down like you see in many other businesses. So let's dive right in and I will present my case about the 7 reasons that I think it is the greatest business opportunity and long-term investment. The very number 1 reason is recession-proof business model. And I know I have argued this many times in many previous episodes where I say gas station is one of the very few businesses that are recession-proof. And especially I bring this topic up because we just are coming out of the recession that we have had since 2008. And I know it has caused a lot of pain and headache, and a lot of people have suffered quite a bit of loss due to that slowdown back in 2008, 2009, and 10. I know I have lost a lot. So to me, this is very important to be in a business that doesn't get affected by recession. And what if we get another recession? In our lifetime, we may see 1 or 2 more. So we need to be prepared for it. And in my opinion, gas station business is one of the best recession-proof business that is out there. Why is it a recession-proof business? Well, that's one of the reasons that I will discuss out of the 7. But just to give you an example, in recession, people don't buy luxury items. People buy what they need and they have to survive. And whatever a gas station sells are those items that you need regardless if you do not have a job or if you do not have an income, but in order for you to survive, in order for you to apply and get a new job, you need to drive over to that location. And how do you do that? You need gasoline in your car. You need fuel. That is why I say it is one of the best recession-proof business that is out there. And also remember, back in the 40s, 30s and 40s, when the Great Depression hit, people said one business that survived and thrived was the bar business, meaning the drinking. See, when people were depressed during the Depression, because of the Depression, they started drinking more. So alcohol is something that people buy more when they're depressed. And in gas station, we sell alcohol. We sell beer, we sell wine. Though it may sound rude or it's the truth, it's the hard reality, but that is true. When people generally are down and they lost their job, then they want to forget that pain, and time to time they drink more, and they drink what? Beer and wine and those type of things. So alcohol is always a good business during recession and in normal times as well. So again, it is truly a recession-proof business, especially due to the nature of product line that we carry. Number 2 reason is relatively fewer competitors that you're competing with. Consider a fast food. Consider a sandwich shop. In a square mile, you may have 7 to 8 places that sell hot food. It could be a Chinese restaurant, could be a Subway, could be a Quiznos, could be many other things. Even most grocery stores have deli nowadays. But in that same vicinity, how many gas stations are there? Not 7, 8, or 10, maybe 3 or 4. So you're competing with fewer people. So you're not slicing the pie as thin as the food businesses are. Think about a restaurant in your area. Think about 10 years ago. How many restaurants were in 1 square mile of your house? Let's say if there were 7 right now, I'm sure if you count, you will see at least 14. That means in 10 years, they doubled in numbers. But in population count in your area, I'm sure it didn't double. If you had 20,000 people living in that area in the 1 square mile, for example, which is very high and densely populated, so that's a high number to guess, but let's say 5,000 people. It didn't end up being 10,000 in just 10 years. Population didn't double, but the food places doubled in numbers. So what essentially happened is that pie got thinner and smaller and skinnier. So the same pie is being sliced and everybody's taking a smaller one. So in reality, if let's say one of those restaurants 10 years ago was selling $5,000 a day in food, right now they may be doing $2,000 a day, barely surviving. Now, similarly, look at gas stations. Let's say 10 years ago, how many gas stations were in 1 square mile within your house? Let's say there were 2. Right now, you may see 1 more. Let's say 3. So you see, it didn't double. It went up. So you're still slicing the pie a little bit thinner, but not as thin as restaurant business or some other type of business. Remember this. Anytime you see a business with a low barrier to entry, that means more and more people will get into that business because they can get into that business with relatively lower cost and easier to enter that business. A lot of people think this way, hey, I go to this restaurant and they're always busy, so I should open one up. And next thing you know, somebody else is opening one similar to what you do, very close to you. And they try to make it a little bit different than yours, try to add a few things that you do not have, and try to take a slice of your business. Next thing you know, another person tries that same thing, maybe within a mile from you. So anytime the barrier to entry to any business is lower, that means more and more people will get attracted to that because they think I can get into it easily. And as I said, gas station business is something that's not very easy to get into because you can't just go and build one up. You have to find one and you can buy one that is doing existing business. It is not very easy to pick a location and say, here, I will build one tomorrow. Not that easy. Number 3 on that list is just what I was talking about, selling basic necessities. The reason, as I said, that gas station business is a good business model because it's a recession-proof business. And the reason it is a recession-proof business is because the product line that we sell some of the very basic necessities. Regardless how much income you have or if you lost your job, you still will need milk for your kids. If you're a smoker, you will need your nicotine. If you enjoy alcohol or beer, you will need your beer. And where do you go when you need a pack of cigarettes or a 6-pack of beer or a gallon of milk? I'm sure most of you don't just drive to a grocery store just to pick up a gallon of milk. You go to the corner store, and that's where we come in. Yes, you pay maybe 50, 75 cents higher a gallon of milk, but you get a better deal on cigarettes and beer. And the best thing is you can pull right in and out within a minute. But if you go to a grocery store, you park your car, you walk about 30, 40 steps or maybe more and stand in a line, buy those. So that's why we are called a convenience store, because it's convenience. It is convenient for you to pull in right in front of the door, walk in, buy the milk, get out, and get into your car and go home. It's fast in and out. So you pay for the convenience, but you buy the basic necessities that you have in your life. We sell most of those, including gasoline, of course. So that is the reason our business tend to survive most of the turmoil of economic slowdown, economic growth, which is the other side of slowdown, or just the normal times. Regardless what time we're in, you will still need all these things that we sell. Now, if you lost your job, you may not go buy an expensive suit or pair of shoes, or similar items. You may not go and eat at a fancy restaurant, but you will buy that tank of gasoline that you need. You still will buy that gallon of milk. You still buy that pack of cigarettes or that 6-pack of beer. That's the difference. You will cut down, you will budget and eliminate some of the luxury things that you used to do, but you will not sacrifice when it comes to these items. Number 4 on that list, high profitability. Typically in gas stations, we tend to generate quite a bit of profit selling merchandise. And if you listen to just the previous episode, which is episode 38, I spoke about how gas stations make money. And I offered a P&L, profit and loss statement, showing if a gas station does $100,000 worth of business a month and 100,000 gallons fuel. I'm just taking an example so I can show you how gas stations make money. And in that episode, I discussed that in merchandise sales, typically we make anywhere from 17 to 18% all the way up to 50% profit margin. And I also showed a calculation where by selling $100,000 worth of merchandise, we generated about $26,000 worth of profit. And what I did is I wanted to be on the safe side, so I took the lowest margin possible, even though in our stores we tend to do higher margin, and most other gas stations that I've seen tend to charge a little bit higher, with where the profit margin goes higher than 25, 26%. Typically a gas station generates around 28 to 29% profit margin. Yes, there are exceptions to that rule, but generally speaking, it's about 28, 29%. But for to be on the safe side, I calculated, I believe, right at 25.5 or 26%. So still, if you think about it, not very many businesses around you can generate 25 or 26% gross profit on products that they sell. There are businesses that can operate at just 7 or 8% profit margin. But in our case, that's not the case. We generate more profit because our standard, our industry is set up that way where we can generate about 25, 26% composite margin on all the items that we sell. That means there are some items we sell that are 30 to 40% profit margin, as high as 50%, and there are low margin items like cigarettes that we tend to make only 15, 16, 17%. So when you take the average of all this, you still come up with about 25 to 29% profit margin. And as I said, not very many businesses you can show that generate this type of profit margin. Yes, we make less on fuel, but we still make decent profit out of fuel. And in that episode, I discussed it in length and did the whole calculation where you can see by selling 100,000 gallons fuel, a typical gas station can generate right around $11,000 profit. So that is roughly about, depending on gas prices, of course, and the selling price. So percentage-wise, I tend not to say gas prices in percentage because it can be very deceiving. When gas price was $4 a gallon, you may say it's 1% profit margin or 2% profit margin. But when the gas price is at $1 a gallon, it sounds very high. Well, I made 11% profit margin on fuel. So I tend to look at gallon versus profit, not dollar amount versus profit. And that way, I can understand better, and the numbers do make better sense at the same time. When I say I sold 100,000 gallons and made $11,000, sounds better than I sold $279,000 worth of fuel and made $11,000. Because, as I said, when the prices are higher, you will still make the same money, but it will sound like you sold a lot more to make that little money. So the comparison should be gallon versus profit and not dollar amount, as the dollar amount can fluctuate heavily. If you haven't listened to that episode, I would strongly recommend you listen to episode 38. You will know what I'm talking about. Now, number 5 on that list, low interest rate. Well, interest rate is not always low. So if you're listening to this podcast, let's say 5 years from now, maybe interest rate will be higher. But right now in 2016, the interest rate, commercial rate, is still relatively very low. So if you're looking to invest in real estate, this is the time to get into it because, as I said, relatively interest rates are very low right now. So when you buy a gas station with land, and let's say you paid $1 million, let's say the interest rate right now, based on your credit, based on your records, based on your financials, let's say you get a 5% rate, which I'm not sure if you can get 5% right now. Let's say it varies anywhere from 4 to 7%, depending on your case. Whatever you get, still relatively that is lower than, say, 7, 8, 9 years ago when interest rates were at 8 to 10% for some of these commercial businesses. And anytime you can save 1% even out of $1 million, that's quite a bit of money. So this is the time to get into this type of investment because it's a long-term investment. A gas station or any other type of real estate investments in business is a long-term investment. So if you can buy a business, a gas station business, or any other real estate investments at a lower interest rate compared to a few years ago, let's say you're saving 2% by buying it now versus a few years ago, what happens to that loan in its lifetime? Let's say your loan is only for 11 years or 10 years. You will save over $100,000 just in that lower interest rate savings. It's a quite a bit of savings. When you divide that into month, it's quite a few dollars that you can think of it as you're earning that money by buying it at a lower interest rate. Just to give you an example, I recently just crunched some number in a mortgage calculator. Let's say you're borrowing $1 million to buy a gas station or to build one, whatever the case is, and your interest rate is at 7%. Your loan term is 15 years. Then your principal with interest payment would be right around $8,900. It's $8,988 to be exact. Let's say $9,000 a month. Now, the same loan, if you get it at 5% interest rate, 2% lower, 5% interest rate, your payment goes down to $7,907, which is almost $1,000 cheaper, lower than 7% payment at 7%, which is almost $8,000. So if you look at that and think about this, that you're saving exactly $8,000 a month, which translates into $12,000 a year. And over the 15 years term, you're saving $180,000. So you see that it is a significant amount of savings. Just think of it, $1,000 savings a month, meaning somebody's paying you $1,000 to your business that you can add to your bottom line profit. Think of it as you're earning that profit. Because if you would have gotten that loan at 7%, yes, I'm sure you'd have paid that $9,000 note payment. But if you can get it at 5%, which the interest rate is lower now, you can save $1,000 a month. Think of it as a profit coming to your store every year for next 15 years. It's guaranteed income for you. That is why I say time to buy is now. Number 6 on that list is longer life cycle than most other retail businesses. Well, again, as I said, if you looked at some of these other businesses, some of these other franchise businesses, there are some that have survived 30 years, 40 years. Yes, of course. But I'm sure you have seen some franchise fast food or other non-franchise food businesses. Then other, let's say I mentioned about strip malls that you have seen that half of them are not rented, the newly built ones, that some of them have only 2 or 3 stores that are rented and rest of them are vacant. Then there are storage facilities that I've seen people build over and over, and there are half of them that are almost empty nowadays. Similarly, I have seen apartment complexes that are being overbuilt right now, that some of them are running great specials to get people into those things. Similarly, same thing happened to housing market. After the foreclosure disasters that have taken place in the last few years, too many people got into it by watching those shows, Flip and Flop and whatnot, where they think we can buy a house and refurbish it and sell it for a profit. Yes, there were people that made great money in this. And there are still people that are making good money, that are investing wisely. But if you are getting into it and just buying 1 or 2 and not knowing what you're doing, you can lose money doing that, and especially since the market is saturated. See, anytime, as I said, the barrier to entry is low, people will get into it. They will saturate the market, and thus they will hurt that business overall. They will hurt themselves, but they will hurt others as well, because they will drive the price down. It's the simple philosophy, or simple principles, rather, of economics. Supply and demand. If the supply is higher than the demand, then the price tends to get lower. You want to get into a business where the demand is higher than supply, or supply is always limited. That way, you can still charge a decent profit margin and decent price and still make money and not worry about other people opening similar businesses left and right around you. And again, as I said, there are exceptions to this rule. There are businesses that people are making money, that are thriving. But I know my line of business, and so I will advocate for my line of business, because I don't know any other business that can survive for 20 or 30 years and still make decent money. So the life cycle of a business is very important. Let's say you found a business that makes great money, that makes 20,000 a month or 30,000 a month. What if that business only survives 3 to 4 years? What happens then? Would you rather have a business that generates 10 to 15,000 a month for 30 years versus a business that makes 40,000 only for 3 years or 4 years? That is the theory, that is the philosophy, and that is the thinking process that I go through. My theory is slow but steady. And always remember, if you invest in real estate in a gas station, it's usually in a very good spot. Gas stations are usually in corner and a busy intersections and similar type of locations where the real estate itself holds quite a bit of value. So even if your business 20 years down the road doesn't do very well and you want to shut it down, you can still sell that piece of real estate for some good value. So always remember that the life cycle is one of the most important decisions that you have to consider when buying a business. You need to worry about that because, as I said, some business can show great profitability. But if the barrier to entry in that market is relatively low, then rest assured, a lot of people will get into it in the coming years. So you need to find something where it's not that easy to get into. Just go and build something that fast and easy and have a huge gas station next door. It's not that simple. Okay, and number 7, the last one on that list, is high return on investment. Well, again, it goes back to all these points that we spoke about. It's a good, profitable business because we tend to make 25 to 27% on merchandises and about 7 to 9%, 10% on fuel, which is not bad when you consider the life cycle of that business, because it will generate that profit month after month, year after year for you for decades to come. Yes, again, there might be a bad one that may get affected by a high volume competitor that can come near you, but that risk is there for every business. So when you do your due diligence before you buy your business, make sure there is not a vacant corner in the very next street over you. And if there is one, find out what kind of a property that is and what and how they classify that property, because there are classification of commercial properties that has deed restrictions. Some properties, some will not allow to have a gas station, some they will. So once you know that, if you think that yes, it's good enough, big enough for some company to come and open a gas station, you may not want to buy the next door one. You may go find something else or somewhere else. So there are ways you can minimize your risk. You have to do the proper research. But as for ROI, as we discussed many times, that return on investment when it comes to gas station is really good. Let me explain how. Let's say you are looking to buy a station, a business that is for $1 million, and you decided to put $150,000 down. So you're financing $850,000 at 5% for 15 years. Your mortgage payment will be right at $6,500 or $6,700, I believe. Let's say the business that you're buying generates about $12,000 to $14,000 net profit. And when I say net profit, it's already the mortgage payment has been calculated in that expense report. So your net take home is, let's say, $10,000 to $12,000, which is a good investment. But what makes it sweeter is at the end of the year, when you go to file taxes, you get to take expenses such as depreciation. A gas station typically has so much equipment, tanks, pumps, canopies, register system, walk-in coolers, and so many other things that you can depreciate in accounting and take those as a deduction on your income tax. And these are thousands of dollars of depreciation costs that you can take legally on your income tax. So that makes your return on investment much higher because you're saving money at the end of the year in your tax return as well when you're filing your taxes. Say you made $12,000 every month and you're filing your taxes. At the end of the year, you should be paying quite a bit of tax money that you owe to government. But once you calculate those deductions, your tax due would be much less than what you're calculating right now. Because, as I said, some of these depreciation costs can be significant. And you can take this depreciation over few years. Let's say some you can depreciate over 5 years. Some you can depreciate over 7 years. Your accountant, your CPA can guide you through those because they know the rule on these. And I know one thing, that it can save you a lot of money at the end of the year. So any which way you look at, it is a great investment because a gas station typically survives anywhere from 30 to 50 years. I have seen stations for the last 30, 35 years that are still in the same place doing the same business. So after the 15th year, let's say your loan is 15 years. After the 15th year, what happens? That same rent that you've been collecting for your store. Let's say you don't own the store. You don't run that store anymore. You want to lease it out. And if it's a $1 million store, typically you can collect 1% of that value as a rent. So let's say you're collecting $10,000 rent. Once your loan is paid off, that $10,000 is yours to keep. Yes, you may not get any more depreciation cost after 5 or 7 years, but hey, you're sitting on a paid off property that's generating $10,000 a month rent. Not only that, in the event you decide to sell that property that you bought for $1 million 15 years ago, most likely will be valued at $1.5 to $1.8 million in 15 years. Real estate tend to go up in value. That's the general rule of thumb. So in 15 years, we can safely say that a property that was valued at $1 million 15 years ago should be valued right around $1.5 to $1.7 million, even as high as $2 million, depending on where it is. So let's say 1.5, you paid that property off, you made all this money every month from rent. Now, if you sell it, you get the investment back plus another $500,000 as a bonus. So any which way you look at it, from any angle you look at it, it's not a bad investment. And it is a great return on your investments, any which way you look at it. And that is my take. And I believe if you think hard in these 7 points that I argued today, every one of them will tell you that this is a great investment. This is a great business, even if you don't want to run this business as a hands-on. Even if you just buy the business and say, I'm leasing this business out. You can ask for $100,000, $150,000 down payment for somebody to lease the property and generate decent income over the years. Let's say, another example, the last one. Let's say, again, you bought that property, a gas station, for $1 million. Remember, as I said, you put $150,000 down at 5% interest. Your mortgage payment is $6,700. But general rule of thumb, again, is if you buy a property for whatever price, your rent structure should be set at 1% of that price. So for $1 million property, the rent should be right at $10,000. And you can ask a tenant to pay you that $10,000 rent. In my opinion, before you buy the business, I'm sure you would do some serious due diligence and you would know if that business generates enough money to pay that $10,000 rent. And if so, buy the business. If you don't want to run it, lease it out for $10,000. Now, the only fun part is your mortgage is at $6,700, but you're collecting $10,000 every month. So there is a positive cash flow of roughly about $3,700 for you to keep. That's an income for you for investing $150,000 because out-of-pocket expense for you was $150,000 that you put as a down payment. Now, tell me any other place you can invest $150,000 and get $3,700 a month every month for many years to come, for at least 15 years until your loan is paid off. Once your loan is paid off, you're still collecting that $10,000 rent unless you have gone up over the years. As most commercial leases do, they go up with the pace of inflation. So let's say you did not go up with the pace of inflation. You're still charging $10,000 rent. Well, you're still making money. So don't worry. But typically speaking, most commercial leases has terms where it says every 5 years they will go up by the rate of inflation, which is 2.5%, 1.5%, whichever it is. You can do so legally without anybody raising eyebrows. So once again, if you think hard in these 7 points, you will agree with me that this is one of the best type of investments that you can do. One quick announcement. Some of you have sent me emails regarding some of the bookkeeping tips that I've discussed many months ago, and I was supposed to publish some of these Microsoft Excel formats where you can just enter data and it will calculate all of that for you. And I was dragging my feet and I didn't get it done. But recently another email came and he did remind me that I did forget about this. So I got most of it done, and hopefully I will be uploading those files under resources section on my website, gasstationbusiness101.com. So please feel free to check that out in next 1 week or so. And this way, if you are already in gas station business and if you think you will get benefited from these formats of bookkeepings where you can enter your sales data and all that, keeping a good bookkeeping system, by all means download those. And if you haven't signed up for my newsletter, please do so by going to gasstationbusiness101.com/subscribe. Thank you once again for spending your time with me in this episode. And hopefully I will see you in the next episode.
This has been the one and only Gas Station Business 101 podcast with your host, Shabbir Hossain. This podcast was brought to you by CSB Academy Publishing Company. Be sure to join us next time as we share with you the secrets about how to start and operate a gas station business successfully and make money.